I think your next guest ought to be somebody from the SEC to explain why they have sat back calmly, quietly, without saying anything, and allowing these algorithmic trend-following models to wreak havoc with what has up to now been the best capital market in the world. Okay, and they don't seem to say anything. You know, in the mid-1930s, they instituted the uptick rule to deal with the abuses of 29. It worked effectively for 70-odd years. They took it out in 2008 for some unexplainable reason, and they've created a wild, wild west environment in the stock market. And this volatility is destroying confidence. Now, what I know from 50-odd years of investing, you know, bear markets don't materialize out of immaculate conception. They come about for certain fundamental reasons that the stock market is seeing. So number one cause of bear markets is the stock market smelling an oncoming recession. I won't cite all the economic data, but there's just no signs of recession. The ADP, flash employment number, the economy is growing. Is it going to grow at a slower rate next year than this year? In all likelihood, but it's growing. Okay. Number two, inflation. Inflation is moderating. Inflation is now below the Fed's target. The third cause of bear markets is a hostile Fed. If anything, the Fed has been too easy, and the level of interest rates are totally non-competitive to the stock market, in my opinion, in any kind of historical context. The 10-year bond is now, I was out this morning, but I think it was 2.8-something%.
Yeah, 2.87, and it may be lower at this moment. It's 2.85
okay.
as we're looking at it right now.
Let me give you a statistic. Okay, in the last 50 or 60 years, the S&P multiple averaged around 15. Okay, we're using $172 in S&P earnings, so the market multiple now is about 15 times. But in that 50, 60-year period where the multiple in the market was 15, the 10-year government averaged over 6, currently less than half of that, and the average Fed funds rate was 5%, currently a little bit over 2%. Okay, so, you know, relative to interest rates, the stock market's a bargain. Earnings are growing, maybe 6 to 8% next year. The PE is very reasonable. As you know, I often quote the great line of John Templeton: bull markets are born of pessimism, grow in skepticism, mature in optimism, die in euphoria. Where's the euphoria? Everybody's looking over their shoulder, worried about things. And so, you know, I have to say that I would buy my favorite stocks here. Okay, I know what the issues are. We have extended profit margins, which tend to be mean reverting, but there's no signs that margins are heading down. The country is possibly moving to the left, which is a longer-term concern that I have. The young people today don't embrace capitalism, okay, and that's a problem. Third, we have a debt problem. There's no question about it, but I don't know when that hits. And fourth, we have an unconventional White House that destabilizes people periodically.
But what if the economy, Lee, is slowing more dramatically than people think? And for a variety of reasons, whether
ask me that question when the market's up 50 S&P points, not when it's down 50. All I know is earnings are coming in better than expected. Earnings estimates are going up. There were 2 or 3 companies reported this morning. I'm a little out of touch, but my team sent me an email. They were better than expected. Guidance was increased, etc. You know, when in 1987 during the portfolio insurance, and I guess I should make the point. I've lived through these periods in the past. We had portfolio insurance, okay? The market one day dropped 22%. Everybody yelled recession. There was no effect on the economy, okay? People are less involved in the stock market today than they were involved back in 1987. And the market is now down 10% from the high. It's just a correction for the market. There's no sign of a trend change. But if you want to hypothesize we're going into recession, sure, we'll all be wrong. We won't earn $172 in S&P earnings. We'll earn 20 or 25% less, but there's no signs of that. You're just responding to a market. Okay? In January, you were probably, your team was nervous that the market was going to the moon. So these trend followers, basically they buy an up market, they sell a down market, they exaggerate the moves, and that's my position. Now, I could be dead wrong, but my position is based upon no recession, Inflation, not a problem. The Fed is far from hostile. Okay, bonds are non-competitive with stocks. Earnings are growing. Employment is growing.
What do you make, though? What do you make of the move in yields? Why is it happening the way it is? I don't know very many people who expected the 10-year today to be at 285. You know?
I would agree with that, but I think it's a very complex situation. If I put on my screen bonds around the world, okay, in Germany, their 10-year rate is 38 basis points. Okay, in Italy, it's 3% with all their problems. In Spain, it's 1.5%. Okay, in Sweden, it's 0.4%. In Japan, it's 7 basis points. You imagine lending money to Japan for 10 years for 7 basis points, or lending money to Germany for 10 years at 39 basis points? So these low interest rates around the world are affecting our interest rates.